Hello, everyone. Hopefully you can see my screen. Welcome to tonight's session, using derivatives to trade your view. Now, I'm just going to wait a little bit longer because, you know, it's 7 o'clock on my phone, but I'm sure there's going to be a few scragglers, as always. I might just say that, you know, with lockdown in Victoria, I am doing this from home. So, and actually Tim is as well. We both are doing this from our homes, right? Using the magical technology of the internet to bring you this presentation tonight. But just be mindful, both of us actually have dogs. I've got a little Jack Russell Cross Fox Terrier, and she's a handful at times, as I'm sure if any of you have dogs, you'll know. And so if she makes a few noises tonight, I do apologize. And I've also got my partner working next to me as well. Tim has a couple of beautiful Samoyeds, and if anyone walks by the front door, they've been prone to barking. So if you hear them, well, I guess count yourself lucky. So just be mindful, there might be a few other presenters on tonight as well. Uninvited, I will say, though.
Presenters of the fluffy variety.
That's right, exactly. Fluffy presenters. But in front of you, you should be able to hopefully see like a little chat box. So what'll happen is that there'll be like a question and answer section. And I'm hoping your end looks similar to my end, where you've got the questions there. And you should be able to type in your questions, and Tim and I will get to them either as they come, or I think largely we'll answer them at the end of the session as well. Okay. So what I might do is I might start, but if you do have any technical issues, just try and ring through, and I'll jump on and try to help you when Tim's presenting, or Tim will help you whilst I'm presenting. So you might be wondering who we are. Well, look, you know, this is the second part of a two-part webinar series. And if you join the first webinar, you will know that we're Trader Circle and we're Emerald Financial. And Trader Circle is a group that's been around for over 15 years, and our goal is to support traders. We're traders that support traders. And I use that word very deliberately. Trading for us is short to medium term. Quite often it's with the goal of trying to generate some kind of income stream. Emerald Financial, on the other hand, is a newer company. It's a sister company, and it's more focused around investment. And, you know, we wanted to be able to serve both types of clients because, I mean, let's be honest, those two overlap a lot, right? But we wanted to keep those kind of two identities separate, right? Now, tonight you're hearing from Trader Circle. And so our approach, like last week, is going to be a lot more focused on shorter to medium term trading, right? And I've got a little slide here. These are the three things that we're going to be covering in that context. So we're going to talk about the market, or Tim's going to talk about the market. You know, what's happening, right? What's going on right now? I'll give you a hint. Over the last week, not much, right? But I'll let Tim extrapolate on that. We're going to talk about options, and options are a very unique instrument, right? Complicated, but very unique and very, very helpful. Something that we love to teach our clients to trade. And we're going to go through a few different strategies that we think are very useful in order to, you know, try and generate an income stream, as I mentioned earlier. So, and at the end, I am going to talk about our options course, right? So if you attended last week, I did talk about the beginners course that we run. So if you're someone who's new and you want to learn how to trade properly and effectively, and you want to be supported as you learn, and you want to have your own mentor, then the beginner's education is something that we encourage you to look at. And tonight I will touch on our options education, which we wouldn't typically recommend you do if you're a beginner, because options are complicated, and what we'd rather do first is teach you how to trade, so how to pick direction and how to manage your risk effectively. And then later on, if you want to, we'll teach you, you know, an instrument that we think is really effective to use as a trader, right? So I'll touch on that a bit further down the track. Now, if you didn't catch last week's, I just thought I'd introduce ourselves. I'm Caro, and the other presenter that you just heard briefly there talk about the fluffy presenters is Tim. Tim and I have both been with the business for, I think, about 8 or 9 years now. Quite a long time. I think we started roughly around the same time. And Tim used to do my job, which is a trainer and advisor. Now he's the head of the trading desk, right? Has a lot of responsibility, a lot of fingers in all the pies in pretty much every aspect of the business. And so you're going to hear from someone who not only educated, but is also a professional trader and someone who looks at the market and helps people with their trading every day and manages a very busy options trading desk. I myself am more of an educator. I mean, I'm certainly an advisor as well. I every day talk to people about their positions and help them with their positions, give them advice on their trades, how to price up strategies. I recommend trades and strategies to my clients as well. But a good degree of my skill set lies in educating as well. Right, so I'm the head trainer. If you come along and learn about options, chances are you and I will be working one-on-one in order to make sure that you understand exactly what you're doing and how they work and the different strategies that you can apply in order to trade different market conditions. So I'm going to run through the education section tonight, and Tim is going to run through the more practical application. We thought that was a really great way to kind of show off our different skill sets and to run tonight's session. Of course, as I said earlier, if you do have any questions, please type them in. We will get to them, you know, even if it's at the end of the session. Now, I just want to say before I kind of get into the guts of it that any advice contained in this presentation is general only. So it's not tailored to your personal circumstances, and you therefore need to decide for yourself as to whether it's appropriate to you. All right. Now, options. We're going to run through some very basic education, okay? And I give you fair warning right now that options aren't simple. And so I'm not expecting you to learn or understand what options are by the end of the night, but I do expect you to at least grasp the concepts. And if I can get you to grasp the concepts and get you interested in this area, then my job is done, all right? So just a bit of a frame there. Now there's two types of options. There's call options and put options. Right? So all the wizardry that we do with options, all the advanced spread trading that you might have heard before, all the different strategies that trade different market conditions, all come down to buying and selling these two different types of options. Call options increase in value when the underlying stock goes up. So, for example, if you buy a call option on CBA, right? We all know CBA stock, Commonwealth Bank. If CBA share price goes up, then so does the value of the call option. Okay. Put options, on the other hand, are the complete opposite, right? Which is why they exist. So in this case, put options increase in value when the underlying stock goes down, not up. So for example, if I were to buy some put options on CBA, then the value of those put options would increase as CBA's share price fell. Does that make sense? I mean, this is very umbrella stuff here. This is very broadly speaking, but in essence, call options make money when the stock goes up. Put options make money when the stock goes down, right? And we use them in conjunction with each other and buying and selling to do those kind of sophisticated strategies. So that's all well and good. Look, I guess that's the main concept to kind of grasp here, or one of them, but we'll go into it a little bit more. The reason that we like trading options, the reason that we like options is because ultimately they're flexible, right? And that flexibility comes in the ability to trade different market conditions and to also have leverage. So when I talk about trading different market conditions, there's option strategies that make money when the stock goes up and down, as I just showed you, but there's also strategies that make money when the stock goes sideways. Right? There's even strategies that profit from multiple directions. So you can make money if the stock goes up and sideways, or you could do a strategy where you make money if the stock goes down and sideways. You can even do a strategy where you make money if the stock goes up or down, right? Which is pretty cool. Like you lose money if it goes sideways because you can't make money on all three directions. So what you do is you do it around like volatility events, like a reporting date. So as a quick example, twice a year in Australia and across the water, companies report their earnings, right? And it's not unusual for that company to report its earnings and then move like 5% either way. And what we'll do on the days leading up is we'll implement an option strategy that makes money if the stock rises enough or falls enough. We don't actually have to pick direction. Now, the other benefit to options is there's a high degree of choice when it comes to leverage. And if you don't know what leverage is, we did touch on it last time. Leverage is the ability to ultimately use less capital to make more money in comparison to buying and selling stock. But the flip side of that, or the other side of the coin, is that you can also lose more money, right? Now, I do want to clarify right here and right now, any strategies that we teach at Trader Circle, or any of these strategies that we run tonight, you always have a capped risk. So you cannot lose more than what you put in, or you're very aware of what your risk is and it's capped. That's the only way we teach people to trade. Okay, so but with leverage, you can make more money with less money, which means you can also lose more money with less money as well. And that's really awesome if you know how to do it right, because ultimately means is that you're less capital required. So, you know, you don't need to put 20 grand on one trade just to make a decent return. You can use a lot less than that, right? That also allows you to diversify your portfolio, doesn't it? Because ultimately, if you have, let's say, I don't want to put a number to it because I don't want to mislead anyone, but if you have X amount of dollars, right, and that you would typically use for stock trading, instead, you could split that one trade over, say, 3 trades because of the leverage. And that would allow you to diversify your positions, or it would allow you to have less capital in the market if you wanted to take some risk off. Does that make sense? So both these things combined make options the most flexible thing that you can trade in our market. And as traders, that's fantastic. Now, I'm going to go through what a call option is, okay? Right, I did give you a brief idea as to what a call and put option are. But I actually want to explain, you know, what it is they actually are, right? So if someone says, I bought shares on BHP, what does that actually mean? Well, you would say, oh, you know, a share is, you know, part ownership in a company and it gives me rights into some of their profits, etc. You would explain what it is, and I'm going to explain what a call option actually is. A call option is an agreement between two parties, and it gives the buyer the right to purchase the stock at the strike price during the life of the option. And they pay for that right. I'm going to run through examples, right? The seller of a call option therefore takes an obligation to sell their stock at the strike price during the life of the option. But because they're taking on that obligation, they're now receiving a fee. So what does that mean? Because it's kind of wordy, isn't it? And that's, I guess, part of the problem with teaching options, or one of the difficulties, is that it's super wordy and you use the word buy and sell a lot, and it just kind of, yeah, your brain goes all hairy, trust me. So call options give the buyer the right to purchase the stock, right? So when you buy a call option, you now have the right to buy the underlying stock at the strike price, which is a particular price, during the life of the option. So options have a finite life. You can buy options that expire this month. You can buy options that expire next month, the month afterwards. You can buy options that expire in a year's time. They're set expiry dates, so you don't get to randomly pick a date, right? It might be the 15th of, that's the 17th of June this month. Then next month, I think it's the 15th of July. Then after that, it'll be roughly the 16th or something like that. And so options have a finite life, right? So they will expire at some point. You have to, this trade will finish on the expiry day, right? It's not like stock where it just lasts until, you know, either forever or, you know, the stock dies or something like that, right? The expiry, the options have an expiry. The strike price is the agreed on price. So with call options, when you buy a call option, you gain the right to buy the underlying stock at that agreed price. So if we did it on CBA, we might say, well, this call option gives the buyer the right to purchase CBA stock at $75. And that person who buys the call option, they pay for the right to buy the stock. You see how it's a little bit wordy? It gets a little bit confusing pretty quickly, right? So I'm not expecting you to really understand this stuff straight away. I mean, we run a whole course in understanding this, and I run very consistent education weekly to teach this stuff, right? And I've got slides and slides and videos and lots of one-on-one time with clients in order to make them understand this stuff. But this is in essence what a call option is, okay? A put option is the opposite. So remember, if the call option is the right to buy the stock, then a put option is the right to sell the stock. So put options give the buyer the right to sell the stock at the strike price during the life of the option, right? And because they're gaining a right, they're paying for it. And when you buy something, you pay money. That makes sense, doesn't it? Put options sellers or writers, it's another way of saying it, they receive money, right? When you sell something, you receive money. That also makes sense, right? But because they're receiving money, they're now taking on an obligation to purchase the stock from the put options buyer, right? Again, there's a lot of repetition with the word buy and sell, and that's why it can sound a little bit wordy and confusing. But ultimately, this is what a put option is, okay? And you don't really need to understand this in order to trade options. I think you should over time, but it's not. I wouldn't call it essential. So for me to explain something, I think it's always good to kind of express it in a few different ways, right? And this is just another way of expressing it. So as I said, a call option is a contract between two parties, right? You guys understand that it's an agreement between two people, let's say. All right. Now the terms of that contract, because every contract has terms, is the right to purchase CBA stock in this example at $76, which is the strike price, until the 29th of December, which is the expiry. The value of that option is $2. Okay? So that's the terms of the contract. Now, the buyer of the contract agrees to pay the $2, the value of the option. They agree to pay that $2, but because they pay that sum, they pay that money, they now gain the right to purchase CBA stock at $76. Does that make sense? So they pay $2 in order to be able to buy CBA stock at 76. They have that right until the 29th of December. All right? And the 29th of December, the whole agreement finishes. Now, the seller's just on the other side of the coin, right? The seller is just the other party. So instead of paying money, the seller's going to receive money. Again, that makes sense, right? Because when you sell something, you receive money. So the seller of the option or the writer is going to receive $2. But they now take on an obligation to sell their stock at 76, right? Because the buyer gets to purchase the stock. Guess who they're buying it from? They're buying it from the seller. So they get to sell their stock at $76. They must sell their stock at $76 to the buyer if it's exercised. And they have that obligation until the 29th of December. Now, the buyer of the call option may not exercise their right. You know, they might not do that, right? For example, if CBA share price is at $70, the call option buyer is not going to exercise their right. Why would they pay $76 for something that's only worth $70, right? But if CBA share price goes to $80, well, this person still gets to buy the stock at 76. It's their right that they've paid for. Does that make sense? Clear as mud? All right. So a put option, again, is just simply the opposite. The terms of a put option are the right to sell CBA stock, right? If we bought one on CBA, you can do options on many different types of stocks, right? But in this case, just in this example at CBA, the terms of the put option are the right to sell CBA stock at $78, the strike price, until the 28th of June. So this option is going to end in like 10 days or 18 days, right? And the value of the option is $1.50. Okay, so the buyer agrees to pay the $1.50. That allows them to sell their stock at 78, their CBA stock at 78, if they want to. And they have until now, to the 20th of June, in order to do that, if at all. Now you got to think, when would they choose to sell their stock at 78? Well, okay, if CBA stock goes down to $70, they still get to sell it for 78. That's $8 more than what it's worth. That's pretty good, isn't it? But what happens if CBA goes up to 80? Would they sell their stock at 78 if CBA is worth 80? Would they do that? Probably not, right? So you can see how the value of these options start to shift as the share price moves. Now let's look at the writer. The writer is the person who's on the other end of the deal. They're going to receive $1.50 from the buyer, right? That makes sense as well, doesn't it? Because they're selling something. When you sell something, you receive money. So they're selling this put option, or writing it is another way of saying it, and they're going to receive the $1.50. They receive it from the buyer. But they take on an obligation to purchase the buyer's stock, right? Because remember, the buyer has the right to sell. Guess who they're selling the stock to? They're selling it to the seller of the put option. So again, it's wordy, isn't it? Right? If you're patting your brow like I am, I don't blame you. So the writer receives money, but they take on an obligation to purchase the CBA stock at $78 if the buyer exercises the option. Because remember, the buyer has the right. Why do they have the right? Because they paid for it. The seller has an obligation. Why do they have an obligation? Because they received money to take on the obligation. They were paid to take on the obligation. Okay? And that obligation lasts until the end of the agreement, which is the 28th of June. Okay? So, look, if you followed what I just said, which in fairness might have been difficult, especially if you've never heard of this before, right? If you followed what I said, what you might have noticed is that there's a lot of similarities between buying and selling call options, for example, and put options. For example, when you buy a call, you gain the right to purchase stock, don't you? When you buy a call, you gain the right to purchase stock. When you sell a call, you take on an obligation to sell the stock. And again, that makes sense. This person has the right to buy it from this person. This person must sell their stock. That makes sense. Put option is the right to sell the stock, right? Because they're buying the put option. Selling a put option is the obligation to purchase the stock. And can you see the similarities here? The beautiful thing about options is it's kind of like mirrors and reflections of each other. There's a harmony and a balance, right? That you kind of get when you study them. So what we're seeing is that when you buy a call option, you gain the right to do something. But you gain the right to purchase the stock. But when you sell a put, you have an obligation to purchase the stock. Can you see the bridge there? Equally, if you buy a put, you gain the right to sell the stock. But if you sell a call, you have an obligation to sell the stock. And there's the bridge there. Right? Not that that's particularly important. Now, what I want to do is I want to cut to Tim. I hope I kind of gave you a brief idea as to what an option is. At the end of the day, what I've just run through is not particularly important, not to sell myself short. It's just that that's not going to necessarily help you make money, is it? And let's be honest, if you're attending the webcast tonight, it's probably not purely from an academic motive, I should say, or area. So Tim's actually going to run through how we use options in conjunction with each other, this buying and selling of these weird, wordy contracts that make you scratch your brain, in order to actually, practically trade the market and generate income, okay? But I thought, if you enjoyed that, well, I hope you enjoyed that and like you got to understand exactly what it is. There's a whole plethora of education that you can do. If you come along and do our course, obviously, it's something that we teach in greater detail and something that I run through basically every Wednesday with my clients in order to give them greater detail as to how these strategies work. Okay, so what I might do is I'm going to cut to Tim. I'm just going to make him, I'm going to stop sharing my screen. And he should be able to pick it up from there, basically.
Okay, so you should be able to see my screen now, if that's correct.
I can see your screen, yep.
Okay, fantastic. Yeah, so Cara has really come up with a fantastic way of explaining options there. And honestly, I remember back when I was first learning this stuff 10 years ago, guys, and I had to hear that at least 10 times before I fully respected options and what all of that meant, right? So if it's the first time listening to it, guess what? That's great. You've got the first one down. You've got nine more explanations to go before you're going to fully respect it, right? Options are a little bit complicated to learn, but our team here at Trader Circle, we've been doing this for a long time. We will feed you that information in a bite-sized way over a period of time so it will sink in, okay? We know what it takes for people to learn how to trade options. We've been doing this for 15 years. I don't think there's been anyone that's left our courses that haven't understood what Cara just went through, right? But it does take a bit of repetition to really drill that in. And look, the other thing on the other side of it, we use a lot of calculators and things like that these days to help price up strategies. Okay, so if you do come and do our options course, you come out the other side. We'll give you a bit of a strategy cookbook. The cookbook explains exactly step by step how to set the strategies up that I'm about to show you, and how to put it into a calculator so that way you can see the payoff and make some really sound decisions based on those payoffs. Okay, so yes, it's good to understand the product back to front before you go in and start trading it, but it's not the all end all, because we do use a lot of calculators to do the hard, heavy lifting for us. So all we have to do is sit here and do a lot of strategy decisions and picking direction and the like. All right, so last week we went through a few techniques quickly on how we pick the direction. We didn't go into a lot of detail. If you're still uncertain on how we do that, there's a lot of past webcasts that we've done where we really go into a bit more detail on it. So just jump on our YouTube page or our websites. There's links to all of those old recordings. So feel free to jump through some of that content. It's golden. You're going to learn a lot from it, especially a 3-part webcast we did late last year. That went into a lot of detail about the market, technical analysis, and that sort of thing. But today, what I want to do is I want to demonstrate to you guys, one, the power of derivatives and how we use them. And I just want to explain how much respect that you need to give them as well. I don't jump into any strategy, guys. No, I don't jump into any leverage strategy without sitting down and analyzing the strategy on a calculator. So therefore, I'll know exactly where my stops are. Okay, and I'll set my stops at various different technical levels, but I'll know exactly how much I'm going to lose or close to it using my calculator, and I know I'm comfortable with that if it gets down to that stop. I also test to see whether I'm going to make enough profit out of the trade to my nearest resistance as well. And what I do is I have a look and I go, okay, well, overall, I want to make more profits than losses. So I have to make sure that I'm making more profits at my resistances, if that's a word, than what I would at my support levels. Okay, so that's where all the dynamic comes into it, and that's how a whole structure and a system makes the difference. Okay, so we teach a set of rules through our courses. We teach a set of rules on how to pick direction, and then we give you a criteria on how to set up strategy. And a big part of that criteria is where to set your stops. And that's all built in a way that brings the system together that helps you have a bit more of an opportunity to make money out of this, right? I can't say it's guaranteed or anything like that. There's a lot of psychology with trading. You can have the best trading system in the world. If you don't follow it, you're not going to make money out of it, right? Our system is extremely conservative and it does extremely well if you follow it over a long period of time, right? So you can have your good months, you can have your bad months. It depends on the behavior of the market. But nonetheless, big part of trading is psychology, okay, which is another topic. I'm not going to cover that tonight. I'm not going to even scratch on that tonight. What I want to show you is derivatives, and a lot of people in Australia don't understand this, and I don't understand why. In America, the options market is mammoth. It is huge over there. If I was running a webcast over in the US, I would have maybe 500 to 1,000 people on watching. Okay, that's how popular it is over there. In Australia, it's not that well known. Okay, and once again, I don't understand why. As well as mini warrants, and I'm going to show you mini warrants tonight because that's the other derivative that we like to trade, and it's more simplistic than options, and it's a very good starting point if you've never traded leverage before. Anyway, enough about that. I'm going to stop blabbing and getting into it. I'm going to start getting into it. All right, so first things first, what I want to show you is actually a mini warrant. And the reason why I want to show you that is the most simplistic of all the strategies I'm going to show you tonight. Now, the example of the mini warrant I'm going to give is on Fortescue Metals, okay? The reason why I like Fortescue Metals is it's nearing the uptrend. Okay, so it's come back down as we spoke about last week. You can see here that it's been obeying approximately this uptrend since about March of last year. So yeah, that's been a pretty consistent uptrend. It's now squeezing into a bit of a pennant pattern, and we've got resistance back up here near 23.80.24. Okay, now a pennant more times than not will break in the direction of the trend. There's never any guarantees of that, but there's a high probability of this breaking to the upside than it is the downside. We're seeing a little bit of a reversal signal there. Now, our rules wouldn't get you in on a day like today that we teach in our course, but this, I just want to show you this as an example. It has been a very whippy market for this week, so it's very difficult to find things that fit our rules because the market is just whipping sideways, right? There's really not a lot out there in the past few days that will get you in on our rules. And the thing about that is that, like I said, our rules are conservative. It's only going to let you in the market at the right times, okay? And you know, we can't control fundamental news, right? So the right technical times, okay? When the technical analysis gives us a probability of success. You just, like, especially when Trump was in control, you know, everything would line up, and then the next day things can change, right? At times, because Trump would tweet something or whatever. We're finding this year it's been a fantastic year for trading, to be honest, guys. We're applauding the stability that Biden's brought to the markets. And we're applauding the beautiful trends we've been seeing in the market this year. It's been a fantastic time to trade. Okay, so nonetheless, look, this isn't necessarily a day I'll get in on this, but definitely starting to see some buying very close to a support level here, very close to the uptrend. And I just want to show you what a mini long looks like on this trade, and how, you know, using this particular strategy, I can get in and out of a trade in a short-term movement, take my profit, move on, and wait for the next swing. So here is our mini warrant calculator that we have on our members section of Trader Circle. It gives you a list of all the different warrants that you can choose from, different types of gearing. So that's how leveraged they are. The higher the percentage, the more leverage that particular mini warrant has. It also has the knockout levels. So this is you know, this particular mini that I've chosen. If Fortescue drops 7.8%, which is at $20.90, this particular mini warrant will stop out. And I'll get back the value of the difference between the stop and the strike. We'll explain all that in our courses, but I'm not going to go into that detail tonight. This is the calculator, and this is where the decision making begins, right? So what this is telling me here, if I put on 500 contracts or 500 units of this particular mini warrant with that code and that strike, I'm going to be risking $2,330. Okay, so that's the maximum I can lose on this trade. I can't lose any more than that. Now, the probability of me losing that is extremely low, because if this gets stopped out at 2090, it's not a guaranteed stop, but I'm going to get something back for my trade if it breaks through that level. So City First is the provider of this particular product. They're the only provider in Australia for this particular product. And many of you probably would have heard of City First before. So City will unwind, they buy a hedge in the background, they'll unwind that hedge, and that if they can unwind it at $20.90 where the stop is, you'll get back the exact difference between the strike and that. So you're going to get something back from your trade if it does hit that stop. Now, I don't use those stops, guys, personally, right? It's good. It's a bit of safety there. It's great to have. I set my own stops, and I go in and close my trade when I feel like I want to close my trade, right? I don't rely on the inbuilt stops, Okay, I use technical levels. So how do I do that, right? So let's have a look. Now, there's a few levels I can use. Now, the most obvious level here is going to be the uptrend, isn't it? Okay, so if it hits the trend, that's going to be my trailing stop. If the trend breaks, I'll be looking to close this trade. At the moment, that's at $22. Okay, so if it gets down to $22, how much am I going to lose? $400. Okay, I'll be comfortable. I'm more than comfortable with losing $400 on a losing trade. Okay, now what can I make to resistance? Okay, that's the test, right? So the next resistance level is around 24, just below 24 there. So if it does get back up to around 24, I'm going to make anywhere between 400. If it gets a little bit above $600, right? So I'm comfortable with that, right? That's enough profit, okay? And then depending on your risk tolerance, you can drop that or increase that as you please, okay? Sorry, that's been sitting dormant for too long. But you get the point, okay? You can increase or decrease it as you please. And I'll just quickly input that back in. So it was KOL, and it was a price of $4.66 for that mini at the moment. And the point I wanted to make there was, you know, if I could drop that down to 300 units, I'm only risking $1,300. Yes, my profitability and my loss goes down. But, you know, somebody with a higher risk tolerance or a bigger bank might do 800 contracts or 900 contracts. And, you know, you're making 800 to a grand. So this is where you can adjust your risk. And this is the importance of calculators. And this is the importance of understanding derivatives to a point where you can make these types of decisions. Where people go wrong with derivatives is they jump into the ridiculous amount of leverage that CFDs provided, and they don't realize what they're doing. They don't understand what they're doing. They don't use calculators to work out what they're doing. And then all of a sudden they think they're risking $1,000, but they lose $5,000. That's how people very quickly lose money out of trading, okay? Yes, there is. Sorry, just to answer a quick question there, Tim. Are there mini warrants on the XJO? Yes, there is. You can trade mini warrants on XJO. You can trade them on the Nasdaq. You can trade them on the S&P 500 in the US. So you can trade some of the world futures markets, which is really good. You can trade it on some of the commodities markets, so crude. You can trade like we've got one on copper at the moment. Okay. We've got a mini long on copper because we think copper is going to jump. So there's metals, there's currencies, that sort of thing as well, all traded through the ASX. So you're guaranteed by the ASX, guys. Okay, that's the big difference here to a CFD. CFDs, you're trading on a custodial structure. They're not guaranteed by the ASX. You're not trading directly on the exchange. Here, you're trading on the exchange, so you get a lot of layers of protection as well on that. Okay. All right. So let's get across to options, right? Because that's the main thing we want to talk about tonight. But I just want to demonstrate, if you want something quite simplistic, quite vanilla in the sense of a derivative, mini warrants are fantastic for that. Citi offer various other warrants too, but I'm not going to go talk about that tonight. But yeah, they offer lots of cool things, like installment warrants and things where you actually get paid a dividend, right? With the mini warrants, a trading warrant, you don't get a dividend, but there's others that you can. They're really cool products, right? All right, let's get stuck into some options though. What I'll do is I'll quickly show you the difference between buying a call and a mini warrant, okay? With the mini warrant, I'll go back quickly. What you'll notice is that the trade doesn't erode much over time, right? So if you held this through to the 22nd of July, you lose $100 in interest costs, okay? And that's the beauty of the calculator too. It's going to explain things like that. Yeah, so an option though, the price of an option works very, very differently, okay? So with the price of an option, and this is an option that expires in June, and you know, there's $2 grand risk was roughly what I was showing you before as well. Basically with this, you're going to gain a bit more leverage, so you're going to get a bit more bang for your buck. If it jumps up to that 23.74 level, out of a $2 grand risk, okay, which is roughly what I was showing you before, you're making $1,200 to $1,700. But the profit erodes over time, right? So if you waited until July for that to happen, well, see how much the profit erodes. You go from $1,700 to $600 because there's something called time decaying options, and that hurts you when you just do a straight bought position. Okay, so a straight bought call option, which was Cara was explaining before, right? This particular call option, I'll have the right to buy Fortescue at $22.93 until June, and it's going to cost me 60 cents to do that. If I buy 30 of them, that's going to cost me $2,000, and I've got $2,000 at risk. Then the calculator shows me the payoff of that particular call option. So if I held that right the way through to expiry, I lose maximum. I lose the whole lot, okay, if it doesn't move. And that's the danger of options. The beautiful thing about options, if it moves quickly, have a look at that leverage. It's fantastic, isn't it, right? I can double my money at resistance. So if it just jumps to 24, I can double my money. How good's that, right? Like that's really, really good leverage. Then how you control the leverage is how many contracts you do. So if I'm worried about the leverage, well, I can drop my contracts. Or if I'm worried about it, I'll push out to a different expiry. There's all sorts of different things that we will teach you to do to drop the leverage down or increase the leverage. Absolutely at your discretion. You have the control. It's your account, it's your risk tolerance. You're the one in control of that. So the other strategy then I'll lead you into is then using two options, and this time I'm going to buy an option and sell an option to create what we call a bull call spread. Don't worry about the name. Don't worry about trying to retain the strategy. Just run with me here, because where the detail is down here. Now I've still got roughly a $2,000 risk, but have a look at the payoff and how I've changed the payoff around now. If it goes sideways, the loss is only minimal, right? So I've minimized the sideways risk, haven't I? I've capped the profitability if it snaps quickly, but have a look over time what's happening now. As time goes on, I'm increasing my profit. So if it moves slowly up to 24, I'm going to make a lot of money. If it jumps to only 23.30, have a look. I can make $1,500 when I hit expiry. All it has to do is go up 2%. So I'll show you that on the chart. All it has to do is go here on the expiry, okay, which is the 24th of June, okay, 14 days, 2 weeks from now. If it's at 23.30 or above, have a look, right? I'm going to double my money if it's above my sold leg, okay? If it's above 23.39, which is the sold leg of this strategy, I'm going to make $1,900 out of this, right? So that's the flexibility, guys. I'm now making money from an upward to sideways movement, okay? I'm making money from what we call time decay in the options. So we're utilizing the time value of an option, and we haven't explained time value. So don't worry if you don't understand what I'm saying here. Just look at the payoff. The payoff tells the story. And this is what I mean. Like, if you learn how to structure a bull call spread and you've got this calculator, you can then examine the risk. You lean on one of our advisors to help you, and that's how you learn. Okay, so some people learn from a classroom setting. Okay, they can sit in a classroom setting, they can listen to a teacher, they can listen to podcasts and read books and learn and go out and apply it themselves. Most people that I've educated, and Cara's educated over the time, and Cara will back me up on this straight away, most people learn hands-on. Okay, so they learn by looking at our cookbook, putting the strikes into the calculator, which I already pre-populated, by the way, myself before we jumped on here because it's limited time. But the cookbook will tell you how to pick these strikes, what expiries to pick, and then if you're not sure, guess what? You jump on the phone, you speak to one of our advisors, and they'll help you out. Because all of our advisors know that cookbook like the back of their hands. They know the rules like the back of their hands, and they'll help you out. And the more you apply it as the weeks go on, all of a sudden it just clicks and it just makes sense, and you'll get to know how to do it. And honestly, it doesn't take that long. As long as you apply yourself to it and you grab Carlo's teaching straight away, get home, plug it into the calculator, start playing around with it, call the advisors, do everything we tell you to do. Within a month, you'll do this on your own, if you do everything we tell you to do. But guys, look at that. Look at what a financial product will allow you to do this, right? I don't know of any other financial product that will allow you to set up a short-term strategy where you can profit from a sideways to bullish movement like that. right? So we've taken from a call, okay, just a straight call option where time's working heavily against us. We've turned it into a strategy called a bull call, which time's working in our favor, okay? It's working in our favor, which is pretty cool, right? Just to answer another question there, do you teach about options that come with shares? So not really, not in this particular course. With particular, especially particular IPOs or share purchase plans and things like that, you get what they call company options. We're teaching ETOs, which is exchange traded options, which is a little bit different. But no, we don't really scratch on that much at all, Lorenzo. Unfortunately, it's not something that's actually the first time I've been asked that. ASX, Nicholas. Sorry, I keep forgetting. Not everybody sees the question. So, who issues options? Okay, so you'll hear. There's another type of options out there called binary options, guys. They're issued by CFD providers. Stay away from them. Okay, don't touch binary options, in my opinion. You've got no protection. Okay, the ASX issues exchange traded options in Australia. Okay, so you've got to look for the word ETO or exchange traded options. Okay, that's the key point. And you're going to make sure you trade them through a good broker and a good clearer. Okay, to remove also any third party risk there. So we use a company called Phillip Capital, which clears through Pershing, and Pershing is owned by I think is it Bank of America? I think the guys were saying. So the names left me for the moment, but it's owned by a massive corporation with a very low chance of going under, right? So everything we do is to make sure we protect our clients, okay, as much as possible for any risks, any exchange risks and things like that. But exchange traded options is where you want to go. That's what you want to be doing, and that's what I'm showing you here. Okay, but yeah, they're issued by the ASX. There's market makers out there that help make a market. Okay, so often when you are trading spreads like this, there's a market maker on the other side. Not going to go too deep into that, but yeah, ETOs, exchange traded options, Lorenzo. That's right. Yeah. Okay, perfect. All right. So okay, so next strategy I want to show you once again is what we call time decay strategy. We make profit from sideways movement. So let's get across to Newcrest Mining. So Newcrest at the moment's had a little bit of a pullback. Most of our short-term indicators are saying it's a bit oversold. Okay, there's also a bit of support here, just at 27.49. Okay, the lowest it's traded to in the last week is down here at 27.12. Now, there's no guarantees as such that it's going to break to the upside, but you can see here overall in the medium term, momentum's up, has formed a bit of a double top, and it's right at the edge of what we call a pennant pattern. If you don't understand any of that, we teach it all in our technical analysis courses, guys, and we'll scratch on some of that through some of those free webcasts that are on YouTube. So definitely go jump on those as well. What we'd be waiting for here for an entry, guys, is a break of that downtrend line. So if the pennant broke to the upside, then we'll look to execute something like this. Today's not the day. Okay, it doesn't fit our rules to get in today, but I want to show you an example of this strategy because I just think it's a really cool strategy. I've got it priced up at the moment because I'm waiting to get into this strategy myself, but I haven't had the chance to get in because I haven't had the right signals pop up for me yet. So look, maybe tomorrow, all right? But nonetheless, this is the strategy. So we call this a bull put. Bull meaning it's a bullish strategy. Put because we're using put options to structure it. So look, don't get too caught up in that, right? This is what we call a credit spread trade. So net, when we do this strategy, 100 contracts of it, we're going to receive $1,200. Remember how Kara was explaining to you before you could sell an option and receive money from that and take on an obligation? That's what we're doing here. But we never fulfill that obligation, right? Now it's not that we wouldn't if we were required to. We have to, right? If someone exercises, we have to fulfill that. But what we do is we know how to not be called upon our obligation, and it works 98% of the time, right? It's rare that we actually get exercised on these options. What we do is either try and get them to expire worthless with this particular strategy, or we just close them out. Now, understand with these contracts, guys, is if you've taken an obligation, you can close that obligation on the market, all right, by getting rid of and doing the opposite. So if you sold a put option, you just buy it back to close. And look, I know that's going to be confusing. It's going to blow your brains. Just scrap all that. Just focus on this for this moment, right? With this particular strategy, and I'm going to show you on the payoff here, it's a 1 week trade. Okay, so it expires next week on the 17th. So I'm praying that the signals come up tomorrow. If not, I'll have to kick it out another week, right? But this particular strategy, have a look at this, right? I've got this calculator now set on 1 day increments, which means if this shows you what happens between now and next week. What's really cool about this strategy, right, is it's a bullish trade. If it goes down day 1, I'll lose $400, right? If it goes down day 2, I'll lose $900. But have a look at what happens on expiry day. If it goes down to 27.21, I still make $1,200. If it goes down to 26.94 on expiry, I still make $500. So that's what we call a time decay trade. Time is what we want. Now, there's not a lot of profit if this jumps, right? Our profitability is capped, okay? This could jump 8% and I'm not going to make much. So there's always a downside on a strategy. With this, the profit's capped. But in 1 week, I just need to keep Newcrest mining above 27 and I make $1,200. That's pretty cool, right? Now, if you have a look at this, 27's down here, okay? So with the right technical signals, this gives you a very, very high probability of success. Now, we use these strategies in sideways markets, okay? So when a stock is just running really tightly sideways or has a tendency to whip around a lot, these are a good strategy to lean on, especially if you can place those strategies that below an uptrend, okay? So this stock's now uptrending. All right, if you've got confirmation of the uptrend, doing this will put for 1 week expiry, not bad, okay? Now, there's always a risk, guys, okay? So the risk on this strategy to make that 1,200, you're risking 3,800. And only way you lose that 3,800 is if it dips down below 26.50, okay? That's what your loss is and that's what you're managing. Therefore, okay, if this trend broke, and I might set a stop at maybe 27. If 27 broke, I'd be closing the trade out, won't I? Yeah. Whatever the price is, just get the hell out. It's not doing what I want. It didn't obey the trend. Get out, right? And that's trade management. That's just trade in the most simplistic form. That's trade management. You set a level, you set a stop. If it breaks that level, you get out. I'm happy to risk $4,000 on a trade. I'm not happy to lose $4,000 on a trade. I'm happy to put $4,000 at risk and lose 20% of that $4,000. Yeah. Okay. That's the clear picture of trade management. And that's the difference between trading and gambling. Trading is you have a set stop. You know what you're going to lose at that stop. And if it hits that stop, you're getting out. Anyway, I just looked at the time. I'm going to keep pushing through. There's one more strategy I really want to quickly show you. And this is a particularly very popular strategy in a sideways market. It's using the same concept as before, but now we're using 4 different options to set this up. No, it looks complicated. It's not that complicated when you know what you're doing. I'm using the 24th of June expiry for this particular trade, and this trade's on our index, the XJO. Okay, so yes, you can trade options on the XJO. Now, what does our market do, guys? Often, like, let's just have a look at this for a second. Okay, I'll just zoom it out a bit and compress it a bit so you can see what's going on. It moves, it goes sideways. All right, moves, goes sideways. Moves, goes sideways. Moves, goes sideways. It just does that so often. And if I get my ruler out, I'll show you here. This particular sideways move around 6,800 lasted for 92 trading days, 136 days of sideways movement. If you tried trading direction in here, good luck. By the time you got your entry signal, I'll just zoom in. By the time you got your entry signal in that environment, okay, you weren't going to get much movement out of it, yeah? Your best probability of success in these environments through here is doing the strategy I'm about to show you. Now, the market's just moved again, okay? Now, I wouldn't be doing this today, guys. All right, there's a few reasons. Fundamentally, you got a CPI reading tonight, and that could move the market a fair bit. You got the Fed next week as well, and this whole market is just addicted to monetary policy right now. So any risk of changing monetary policy, the market might get a bit knee-jerky. So I'll just wait until after the Fed meeting next week, and then I'll be looking at these strategies again. I'll just quickly show you what the strategy is though, right? So 74.50, okay? I want to keep it below 74.50. And I want to keep it above 71.75, which is roughly here, okay? Now, why have I chosen those levels? Well, in an uptrending environment, if the market pulls back, it tends to use previous resistance as support, okay? And I've tried to get a bit away from the market as well, up at 74.50, just because the market is uptrending. And if it does jump up there quickly, I want to be out quickly, okay? You know, I need to keep it within that band for 2 weeks, right? If it stays between those two levels, I make $1,400, okay? Lorenzo, stay away. I would not suggest trading binary options, okay? I've heard a lot of bad stories about them. In particular, there's a lot of dodgy overseas companies that can steal your money as well. I've just heard a lot of bad stories, guys. They're not guaranteed by an exchange, which leaves them a lot more open to dodgy things happening, right? So stay away from binary options. You want to be trading exchange traded options. Okay, so basically look at the payoff here. If it jumps too much or falls too much, I lose. If it goes sideways, have a look. Within 2 weeks, I'm making my $1,400 to $1,500. All right. So this is what the appeal is for options, guys, is turning time on its head and making money from time instead of losing from time. Most derivative strategies lose from time. There's always an interest component in CFDs, in mini warrants, in buying a straight call option. You lose from time. Okay. These strategies are fantastic for stocks that are just hanging sideways and just whipping around. And it's when you're in an environment where picking direction is really difficult in the short term, these are the types of strategies we lean on. Okay. All right. So look, I hope that sort of demonstrates the power of what you can do with these products, right? They're very unique. These strategies are very unique to options. You're not going to see these strategies anywhere else, but you can Google the names, right? Just go out there and Google short iron condor. That's what I just showed you then. Google bull put, Google bull call. You're going to get heaps of information out there on these strategies, right? They're not unique to us. What we do as a company, though, is we simplify it, okay? And we teach you how to apply it to the Australian market. What you read in books is going to be very vague. It's going to be just knowledge-based. It's going to teach you what an option is. It's going to tell you what the strategy is. It's not going to tell you the actual practical side of it on how to apply it in the market, how to place it in the market, what's a fair price, what's not a fair price, what strikes to pick, you know, what expiries to pick. All that sort of stuff is very specific knowledge that we teach, right? You're not going to get that out of a book, right? I promise you that. Trust me, I know, I've tried. Right, that's why I came and did the course myself years and years and years ago. All right, so look, that's probably enough from me, guys. Look, you know, at the moment the market's just drifting sideways, but we're drifting sideways into some key information. So we want to get that key information out of the way before we start adopting this style of strategy again. So I don't advise you to do that. In fact, a lot of our recommendations that we've put out recently, and I was going to go through some of them, but I've run out of time. We've closed most of our trades down and taken our profit because the market's jumped, right? So we did a lot of bullish trades through this period. We've closed out majority of those bullish trades now, and we're just waiting for the next signal. So that's where we're at with the market, guys. Still bullish overall. Nothing's really changed from what I was saying last week on the market view, except for now we're just taking a bit of a step back, just chilling out for a moment and waiting for the CPI reading tonight, and then waiting for the Fed next week and waiting for that breakout. Once we get a breakout, we can start trading again. I'm going to hand back over to Cara, guys. Sorry, I took way too much time to go through those few strategies there. You know, I was going to go through a bit more, but yeah, time's never my friend with these things. Okay, so thanks for listening to me. I'm going to hand back to Cara now, just so he can just finish this off. Just give me one moment.
All right. Thank you, Tim. I'm just going to start sharing my screen again. And what I want to do is, as I mentioned at the start, I just want to run through the options course that we run. And it's, it'll take only a couple of minutes. I know we're kind of running out of time. It's basically 8 o'clock. So I won't take much more of your time. But if you're interested in options and like basically how we utilize them, then as Tim mentioned, he actually mentioned earlier, it's not easy to understand, and you can go read books and you can go watch webcasts like these and watch videos, and I encourage you to do that because it's a great place to start. But it's actually really helpful having a mentor, and it's really helpful getting some professional education in order to understand how these things work properly, and even more importantly, how to apply them effectively in the live market, right? Because that's the goal, isn't it? So we run a course. We put this course has evolved over 15 years. It's taught by professional educators as well as traders. And the goal is to teach you how to trade options, right? It's run over a 2-day course, right? And the idea is really to cover the basics on day 1, and then basically to teach you how to trade advanced strategies on day 2, right? Now with COVID, we're only keeping it, we are still doing face-to-face, and you can do live stream if you want to. We think that it's best to come into the office. That's the truth. We do think it's best to come into the office if you're local. People fly into state. People come from all over Australia to do our courses. People even come from international sometimes to come and do our courses. So we prefer face-to-face, but with COVID, you can do the live stream if you want to. All right. So it's something that we started to do, even though we think it's better to do face-to-face. Okay. So you come into our office. You do two days. Saturday and Sunday. We do it over the weekend because, let's be honest, it's easier for people, for most people, because we work 9 to 5, Monday to Friday. And you're actually taught by the head of, who used to be the head of the trading desk, Carlo Castellano. He's the co-founder of Traders Circle. So before Carlo basically semi-retired, he used to be the head of the trading desk. Tim is now the head of the trading desk. So you're learning from someone who co-founded the business, someone who taught Tim and I, basically, someone who has been teaching and trading for over 20 years. Carlo's taught locally, he's taught abroad. He's basically a full-time trader now. He just trades at home and still runs the education for us. The other thing that we do is we also provide education, and in terms of from a distance. So after you've done the 2-day workshop in our boardroom, we actually give you access to our members area, right? Because you're not going to learn everything in 2 days. That's fairly obvious. And our company tries to separate ourselves from other businesses, really tries to distinguish ourselves on support. So we build a plethora of resources online to assist you in not only your learning, but also when you're ready to actually start trading with real money. And that comes about in things like market updates, right? We provide trade suggestions or trade recommendations. So if we see a trade that we like, that we think is obviously good, we'll put together an email, send you a text, and we'll choose the strategy, the suggested recommended minimum risk, etc. And we'll flick it to you, and we'll send you a text and say, hey, this is what we've seen today. Go away and have a look, and if you like it, you can do it. So we'll give you trade suggestions, but we also give you training videos that cover what you learned during the 2-day session. All right, and the training videos cover all those kind of core topics, right? Because again, you're not going to remember them. We run daily webcasts every day. So one thing, the session that we ran last week, if you guys managed to catch the first part, the first part was kind of like a little trade group. So we went through the market, we looked for trades as a group last week. And that's actually something that we do basically every day with our clients. So the last session, the first part of this webinar series, was a bit of a taste of something that we do basically Monday to Friday from 12 to 1. Okay, so you'll have access to that, where Tim runs his on a Tuesday, for example. I run mine on Wednesdays, and the other advisors have 1 day a week. And we go through the market, we look for trades. My Wednesday session half of it is spent on options education, purely on options education, going through strategies, how they work and how they implement them. All right, and I don't think anyone else in Australia does that. If you can't attend that 12-to-1 session, it's recorded and it's placed on the website that night. But I talk about these webinars, these live trading webinars we run, because they're so powerful, right? I mean, they're so good for your education. But even as a trader, think about how useful that would be, right? You're going through the market with a professional trader as a group looking for trades every day, right? Just think about how useful that could be to you. So you'll gain access to all of that for 8 weeks. We run a paper trading competition. So during that 8-week period, we pit all the students against each other. The winner gets a prize, and basically it's just like demo. We're trying to simulate real trading. So you can actually call up an advisor and say, hey, I'm in the paper trading competition. Have you seen any good trades today? Ones that I could maybe put in the competition, and we'll do that because it's meant to be like real life. If you called me up and say, hey, have you seen any trades today? I'll tell you. I'd say, hey, yeah, look, I think this is a good trade, or this is something that's worth considering. Here's probably how I would approach it, that type of thing. Yep. And you actually get your own personal trainer. And again, this is something where I think that really separates us from other businesses. You actually get your own mentor, right? You get someone that you can call as many times as you like during the day, ask all your questions to. They're basically there to run point, make sure that you're, not making those silly mistakes that you're prone to making as a beginner, to make sure that you're understanding all the material, to make sure that you're applying it correctly, and just work with you hand in hand to learn this stuff, right? Because again, it's not, the stuff that I ran through earlier in this webcast is all rather academic, isn't it? Anyone can learn that. That's not hard. It's just book knowledge, really. It's the stuff that Tim went through that's really the really important stuff, and that's what your trainer is there to work with you on. Okay, so that's really important. This is how we get you good at trading, and it's within our best interest to do so, because to be honest with you, our education is not a profit center for us. We actually don't really make money from it. So you go, okay, well, why would you do it then? And that's a great question. The answer is, well, it's a stepping stone to working with you and retaining you as a long-term client. So what we want to do is we want to turn you into a successful trader, right? Because then you're likely to continue to trade through us and use our services. You're likely to continue to have a relationship with us. And that's what our business is built on. We're built on retention. And that's another reason why we only run these courses very sparsely, right? We don't run them often. This options course we run once every few months, and we only take in like 10 people. Sometimes it goes to 11 if it gets overbooked or something like that, but we only really take in 10 people. And we want to keep the groups nice and small so that we can focus on you as an individual as much as possible, because it's really important to us that you learn this properly and that you become successful, because we put a lot of effort into it. We put a lot of resources, we put a lot of time into you. We invest in you in a lot of ways. Does that make sense? So the investment of the program is a deposit of $995. That secures your seat. Okay, you pay a deposit, you get access to pre-learning. We'll send you a bunch of things to go through if you want to. You don't have to. We know that you're busy. I mean, the majority of our clients are small business owners, they're full-time professionals, but we'll give you some pre-learning if you want to do it. And then there's 2 monthly payments of $995. So the total investment of the program is $2,985. And what that does is it gives you access to the 2-day workshop where you learn exactly how to trade options, learn all the different strategies that we use as professional traders to trade different market conditions, right? We'll teach you portfolio strategies as well, so that you can use them in conjunction with your shares to potentially increase the yield on your portfolio, or even use them to purchase and sell stock at better prices. You get access to the members area for 2 months, where you will get training videos, trade recommendations, daily webcasts. You get all the technology, so we'll give you the trading platforms, the options calculator, right? And you get your own personal trainer. Now, the next dates are the 3rd and 4th of July. All right, so it's coming, I would say, fairly close. And it's about 3/4 of the way full. Now, typically these things book months in advance, at least a month in advance, I should say. I think with COVID, we've had a few deferrals, like unfortunately Victoria goes in and out of lockdown. But again, that live stream is available too. Now, after July, I don't think the next one will be until October. Okay. So that's the options course. Thank you for listening to that. If you're interested in learning about options, I promise you won't find a more comprehensive course on options trading from a practical perspective. I'm sure that you can go and learn about the details of options really anywhere, right? For example, tonight's webcast gave you very basic understanding. But yes, I mean, learning how to practically apply them, we don't think you're going to find a more comprehensive course with the amount of support that we supply. So again, thank you very much for listening. If you're interested, come along and do the workshop. If there's any other questions, I'm sure Tim and I will address them now before we go. And again, we really appreciate you jumping on and staying. We have gone over time. We are sorry. And if you'd like to rewatch the session tonight, it is recorded. So you can, I think we'll email it to you and we may place it on our YouTube channel.
I'll just quickly answer one question here. So Lorenzo has asked, is the course backed by anyone like ASIC? Look, I can't say that it actually is backed by ASIC, but we do have a financial license with ASIC, Lorenzo. So for us to give the general advice that we give, any financial provider has to have a license, right? Which means that we have to abide by a strict set of rules in conducting the course, and those rules are given to us by ASIC. So can't say it's backed by ASIC, but yes, we are regulated by ASIC, okay, if that makes sense, and we have to abide by Australian financial laws in giving any financial product advice, in particular because we are dealing in listed products and things like that as well. There's very strict guidelines on what we can or can't say, what we can or can't advise to you guys. And yeah, so we're all definitely covered by that. You can see our license numbers on our websites and the rest of it. Every advisor that sits on our desk actually has to be licensed, right? So part of what me and Cara have to do is actually do a certain amount of education every year to keep that license as well. Right, so we have to keep ourselves educated on the markets and what's happening in the financial world and things like that. It's very, very strict, guys. Okay. In fact, later this year, there's a new regulation that ASIC's bringing out in that that's going to affect you guys, okay? What this regulation is going to be is that brokers like Phillip Capital, who we use, are going to have to ask a questionnaire for anyone opening up a stock account, a trading account, and you're going to have to prove that you've got experience to trade options before they're going to allow you to trade options. Right, so that's a big regulation change that's coming later this year. So it's kind of good news for us because we educate people, which we give people experience. Therefore, we'll be able to give people the experience they need before they can open up an account and trade. What ASIC are trying to do is stop inexperienced traders coming in to trade these types of products without doing a course or without getting some experience somehow. And I 100% agree with that, right? I truly believe derivative style products deserve a lot of respect. They're great products. They've got sometimes a bad name out there because people don't spend the time getting educated. They want to go in and they just want to trade them straight away. And I think that's a bad idea. I think getting some form of education, whether it's paid education or whether you go do read books and things like that and paper trade and slowly build your experience levels up, that's always going to be the best way of going about it, right? So yeah, look, that was a long answer, right? But yes, we are governed by ASIC, right?
I think just to add to that, there was another company called VectorVest that has been operating. They didn't have a license. They just got shut down. So, you've got to have, Australia is extremely regulated, and, people make the joke that it's a bit of a nanny country, a bit of a nanny state, and that's all well and fine, but it's honestly awesome. Like it's super beneficial to everyone here because it means that your trading's transparent, it's regulated, and you're protected, right? You're protected from, you're protected, and that's a really, really good thing. So ASIC, regulate, and it's good that they're there. And if you don't have a license, you get shut down. And VectorVest is a huge company. I'm sure everyone here would have heard of them. Yeah.
And look, if you're gonna trade, guys, trade with an Australian company that you know they've got an Australian office. Don't go trading with a company that provides CFDs over the other side of the world somewhere, because you don't have this. You don't have the same coverage, right, as what you've got with us, where we are covered by ASIC. You know what I mean? So just
For
be
sure.
careful. There's a lot of dodgy stuff on the internet out there, guys. I've heard too many bad stories coming out of things like binary options and CFDs and things. So just be careful, right?
And you can come and, like, you know, knock on our door and visit our office. We're on Melbourne. We're on Little Flinders Lane. We're a small business. There's 12 of us, right? I mean, we're a local company, and you know, it's good to support local businesses. Let's be honest. And you can come and say hello, and you can come and see what we do during the day if you want. You can book an appointment, see your trainer face to face. It's good to have that kind of face-to-face contact, we feel. Whereas, you know, you deal with a company in Cyprus, which a few of those binary option providers are, you've got to be careful. Yeah, they're not really, it's not really anything protecting you, let's be honest. Anyway, long answer for a short question, but yeah, I think we might wrap it up there. Is there any other questions? All right, well, look, if you do think of something that, you know, you wake up in the middle of the night thinking, oh, damn, I should have asked them, please, by all means, just flick us an email or give us a call. You can always chat to Tim or I directly, and we're happy to answer any other questions that you have. If you're not sure where you fit, if it's really that good for you, you can always chat to Jared, who's our market advocate. Jared is someone who knows all about our programs. He knows all about the market. He knows all about investing and a whole bunch of different opportunities. And if you have a chat to him, he'll be able to kind of place you in the right place. Okay. It's worth having a 10-20 minute chat. You can always book a time. He's pretty busy, so you will have to organize a specific time to speak to him. Just call up and we'll organize it for you. Otherwise, guys, thank you very much for joining us tonight, and hopefully we see you on next time. We do run different types of webcasts, right? We run beginners, we run three-parters, we run trade groups, we run options, you know, we run different types of webcasts on the market all the time. So keep in touch and keep your eyes out for anything else that you might be interested in, all right?
Thank you very much, everyone. Take care. Bye for now.
Good luck. Happy trading. Thanks, guys.